Kia ora koutou. Welcome to Shared Lunch, brought to you by Sharesies. I'm Garth Bray. We're in the home stretch as we record today, the last full week of trading on markets here in Australia, the US and Europe. So what have we learned this year and how has it set us up for 2026? Joining me for some thoughtful reckons are Paul McBeth from The Bottom Line and Shamubeel Eaqub, Chief Economist at Simplicity. But before we turn to them, let's hear some important information you should always consider before investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Two of the hardest working posters on Kiwi LinkedIn, I would say. Shamubeel Eaqub from Simplicity, Paul McBeth from The Bottom Line. Welcome to Shared Lunch. Merry Christmas.
Merry Christmas.
There is a movie from the 60s called Dr. Strangelove, or How I Learned to Stop Worrying and Love the Bomb. Is this the year that we learned to stop worrying and love the word, or at least not fear the word, tariffs? Did we get over that now?
We definitely got over it in terms of share markets because, when the Liberation Day was announced, we all got liberated from our money very quickly. And then it bounced right back. It's been a spectacular year in terms of share market returns, albeit in a few different, few specific companies.
It's a deep, deep gouge, eh? If you look at that chart, you can just see it bang right there, big notch taken out.
But, we're only now seeing the real economic effects of the tariffs in terms of the increases in inflation, the increases in the cost of goods, in terms of toys and imported things. That's going to be hitting Christmas and into the new year. So in financial market terms, absolutely, we learned how to love tariffs. But in real economic terms, I think we'll come to regret it a bit this coming year.
Is that what you saw looking at the markets?
Oh, yeah, definitely. You had that dislocation so quickly. But even with the bounce back, people seem to be hating it. There's a lot of pessimism out there, even though we're still seeing some of those major indices on Wall Street trying to push to new records. Even though we've seen the likes of Bitcoin come off, it's still at, I think last I saw was about 88,000 US. 88,000 US dollars. It's almost as though people are hating themselves, but just continuing to pile on in. And they've recognised that, you get the sense that there's a recognition that the big arm waving that comes out of the White House and the Oval Office, there might be some sensible people talking there, but it's a lot of it's theatre. It's that whole you get the expectation set up high, everyone runs to it, and then when it doesn't quite sort of come through, then there's a bit of a relief rally. I mean, it's still strange out there. Even where we're at, you just can't quite get a sense of, at international level, people are still talking about it going up, even though we're probably due a correction on the major indices. It's hard to sort of draw a common theme through it all, aside from it just being this increased level of volatility.
You're going to have a crack though, aren't you?
I think there is a common theme. The common theme is don't believe the headlines.
Yeah.
And just because the headline says something doesn't mean that's what's going to be implemented or the effect is telegraphed. I think all the rules of thumbs that we've been using haven't been working. So I think the lesson of the last 12 months has been a lesson in humility. That don't be overconfident. We all had great big predictions of what would happen after the tariffs. Of course, one, the tariffs that were announced were never implemented, and two, the effects on markets were nothing like people had expected. So I think, to me, there's always this reminder. Every retrospective that you do of markets is a lesson in humility.
And that's the big one that you've taken away from. Did you take a tumble yourself?
Oh, I always take tumbles, so the whole point is, I have my retirement money, which is boring and it just does its own thing, and then I have fund money that I lose quite freely. But that's the fun of it, right? You can't not participate in the market and not get burnt. Of course, you can have some wins, but the burns are the bits that are fun, and that's where you learn from.
You're so right, though. I guess money makes it matter. If you're prepared to actually even just put a small amount in there, it's surprising how much, and we could be talking a couple of bucks, you pay attention to what things are doing rather than just sort of flagging it on a watch list, right?
Absolutely. Yeah. And I think it's important to kind of do your savings part boringly and then having the fun money, the at-risk money doing other things. They serve very different purposes. It's really important to have different accounts in your head and in physical terms.
Fair chunk of it, though, would have been tied up in investments related to the AI phenomenon, I'm going to call it at this point, because people seem to be leaning hard on the bubble, and yet it just grows and grows and then shrinks and grows and grows. Are we going to knock the froth off this one anytime soon?
Who knows? Yeah. I mean, the experience of these kinds of mega new technologies is you get massive investment booms. Some investors will absolutely lose their shirt through the process somewhere, but we don't know when. But will the technology prove to be very useful and last for a long time? My prediction is yes. To me, it's more like the railway or the internet. These are big technologies that came through and changed how we live our lives, for better and for worse. And I think AI is going to do exactly the same.
Yeah. Pretty heavy debt load on some of these companies, though. Yeah. I mean, I don't claim to be an AI expert at all, or a financial one, really. I'm just chatting to you guys.
But it's quite a big difference, right? You look at companies like Cisco versus companies like Google, right? And some are still spitting out cash and others aren't. So there is a real divergence in terms of quality of businesses.
There it is. Like when you're looking at the likes of Meta and Google parent Alphabet, they're paying out of cash, free cash flow. Where you're looking at, say, Oracle, which it's funding its investment in infrastructure. It's been debt-fueled in the last sort of ones. And this is where that whole circular arrangement starts getting a little tricky. But Oracle has borrowed, I think it's about $100 billion US. Like that $100 billion US to fund this sort of stuff. That's like more than all of New Zealand's businesses borrowing from the bank combined. And this is where people get a bit iffy about it. Debt is a beautiful thing when it's working for you, but when it goes nasty...
Well, leverage cuts both ways. Yeah. Right? That's the whole point of leverage. It gives you plenty of upside and gives you plenty of downside. It cuts really deep on both sides.
And the predictions seem to be that we'll see like $1.3 trillion worth of leverage applied to that problem of how to make enough power and data centres for AIs. That's one stat that seems to be floating around. These are pretty astronomical numbers. I mean, are they anchored at all?
Well, that's where, and I mean, this is where like Sam Altman from OpenAI starts coming under a bit of pressure, and he got very snippy in a podcast not long ago where he got challenged about the forecast cash generation versus the infrastructure spend. Now, of course, those forecasts are just over a short period of time, and the expectation is that they'll be able to do it. But what if they don't? So, and that's the whole thing. When you're looking at, as Shamubeel was saying, like with these early stage, this revolutionary shift, there'll be some winners, but there's also going to be a bunch of losers.
Yeah. This is entirely normal. I mean, history is littered with these experiences and these kinds of examples. So to me, it's less about going, will the investment take place and will all of it be good? The answer is, of course not, because we're still finding out what's going to work, and that's okay. But you just need to be aware as an investor that some of those investments will go bad. We don't know when, we don't know how, but will there absolutely be winners out of it over the long term? I think so. I'm always reminded of pets.com during the dot-com era, right? There was a company that was valued at all these things. It had no business, it had no revenue, and was still valued at lots of money. That company disappeared, but other companies became real things in the aftermath of it. And I think the same thing will happen with AI. So it's more about how we're going to see the winners shape the markets of future years. And that's why, again, trying to pick winners at single points in time is very difficult. And being active in the market, being participant in the market through time, through cycles, is so critical.
I guess it's an opportunity for some, right? If you're under 40 and you're trying to save, increasingly we're seeing people more comfortable with the idea of, or investing in the market rather than the traditional forms, property and so on. And these are probably the same people whose jobs are most at risk of being pinched out by the very technology they're investing in. Is there a bit of an irony there?
Well, there is, but are those jobs actually at risk? I mean, what happens when you get that dislocation? Some jobs go, but new ones are created. Like, it's not a... you don't just lose everything. Yeah. And AI is not going to come for everyone's jobs and then that's it. What do we do? We've set our systems up so you've still got to have people at least getting some kind of cash, unless we fundamentally change how we live.
I think there is a fear out there, and it's really around AI is good at tasks, not at jobs. So we will see some tasks being automated, and unfortunately for young people, those starter roles are task heavy. So that's where the risk is. Some of the tasks get automated. So instead of having, say, 20 juniors, you might need 10. So the structure of organizations becomes different, and young people will then be much more likely to have more precarious careers. They might be competing more for those few jobs that are of high quality, and there might be more people spending longer parts of their early lives working in not very good jobs. in service jobs, in jobs that don't pay very well, that don't have a lot of security, that don't have good hours. And there is an enshittification of jobs that we have seen over the course of the last few decades, and it has affected younger people more. So I think that fear is real. It's not that jobs will disappear, but the quality of jobs early part of a career, I think, is definitely something we need to be really mindful of.
Does that have a long-lasting impact, though, on someone's ability to earn, on the investment opportunities that they have available to them, on all of these things? You're starting out from a lower base, aren't you?
I think it stratifies people, right? So those who get those opportunities to get into those well-paid jobs with those well-earning industries or whatever, you will see an accumulation of income and wealth for them that's faster. And for other people, they'll be pushed behind for a lot longer. And this is why I think it's when you're thinking about saving and investing, regardless of where you are, it's that importance of thinking about the habit of saving versus trying to pick things specifically, because I think there's a real pressure for a lot of people to go, oh, look, I think I'm not going to earn enough, so I need to take as much risk as possible to make tons of money, and then I'll have freedom, rather than actually looking at what works for most people, which is if you save consistently and regularly, do the boring part of saving, that's probably going to set you up. But a bit of fun money on the side might give you that extra holiday or whatever.
Make a habit out of it, out of doing the basics right, yeah?
Well, absolutely. I mean, the way I save is, I have my basics, which is really a little bit of set and forget. I have a person who looks after that money. And then I have a little bit of fun money, which is for me to kind of go, if I make some money out of it, I'll do something interesting or fun with it. Yep. And also you learn lots by being, by investing in markets, by investing in startups. Like I said, I've lost lots of money on startups, but I've learned so much from it. You just learn, you meet interesting people, you learn about interesting technologies, and that closeness gives you that little buy-in, and that buy-in is really important.
I should add, this is probably a wholesale investment proposition we're talking about here, rather than something that a retail investor can get into, yeah?
Absolutely, but a lot of young people will be investing in individual stocks. So they are making specific bets on particular companies. So it might not be for startups, but you might be doing it in terms of taking a much more risky proposition of having a less diversified strategy. And for me, that's very much for that fun money, that investment money, that learning money, rather than the saving money. They're not the same things.
Was there a particular winner you want to skate about this year, given we're trying to retrospectively look at 2025 and go, gee, I'm glad I made that decision?
Well, I mean, I was actually just looking at my KiwiSaver the other day. Man, it's done bloody well. And, like most of the returns, of course, have come from just the money that you contributed. But the fact that it's gone up so much is pretty extraordinary.
Said the man from a KiwiSaver fund. Come on.
But honestly, my kind of whole experience of private equity and venture capital is they've not actually had very good years for the last couple of years, whereas the financial market has done really well. Just being invested in markets has given you some pretty good returns. The NZX has been woeful yet again.
You say that. I'm sure Paul will pull me up on this.
Well,
what are the returns?
On the 50, you're looking at about 2.5% year to date. On the small cap, you're looking at about 25.
So there is gold in them hills, right? There's stuff if you're prepared to take a risk.
Let's talk about that.
It's
not even the risk. It does sort of correlate more with the idea that New Zealand's economy is on the turn. Domestic sort of fundies out there, the institutional investors, have been looking at the signs of life in the New Zealand economy, those rate cuts that take a long time to work through, and of course stock markets being forward-looking. Those domestic-focused companies have sort of done better out of it. Like Freightways, everyone's favourite economic bellwether, I think, was up about 30-odd% or so year to date so far. And of course, that's also got Australian operations. But in terms of looking at signs of life in New Zealand's economy, those mid-cap and small-cap companies are sort of saying, yeah, we're getting ready for things, and the prices have gone up accordingly. That big end of town hasn't quite seen the same.
But also the big end of town does not really look like the New Zealand economy, right?
No, it
because
doesn't.
the types of businesses that are there are so different from the makeup of New Zealand.
Well, that's it. And it's not
Briscoes and...
Well, but like
mainly
Infratil's down
it's
10%.
utilities, right?
Yeah.
Really.
And Fisher and Paykel, which dominates so much of it, and that's largely an export-focused thing, hinged on Mexican manufacturing as well. It's got issues, even though it's sort of flatlined. I think it was down a touch last I saw, but Infratil getting probably dragged down by the AI unhappiness with its CDC exposure, the data centre hit. Main freight, global logistics, a little bit off the boil. That bigger type thing, struggling. But primary producers, loving life. like Fonterra's shareholders fund.
They had a bit of a sugar hit this year, though.
Well, they did, $2 billion, but
also
dairy
the
prices
have been fabulous.
ridiculous.
That's why our butter and cheese cost so much.
Yeah. Wrightson has been sort of on a tear. Scales Corp, the apple exporter, and also refrigeration type things going great. Turners and Growers, T&G Global these days, which is on the block because its German controlling parent has its own issues to sort out. But
these are all things you think you could have seen at the start of 2025 to some extent?
Oh, not necessarily. I mean, if you're looking at just that, primary sector is always cyclical, right? Commodity prices of raw materials, be it food, minerals, whatever, goes up and it goes down. And anyone who just predicates it on going up, they'll normally get burned. But these prices have been doing well. Fish prices have been going well, and Sanford is another one that's been hitting a tear. You do have to have that confidence over the long term, but you can look at these things and go, oh yeah, I'm feeling a bit more optimistic about New Zealand, and I'm less bearish about the local economy. I've been sort of Pollyanna-ish probably since the middle of the year when I just started seeing some of those retailers, the JB Hi-Fis of this world, actually seeing a bit more coming in the door, and you just start thinking, maybe it's not that bad. Maybe we're talking ourselves a bit too much into a slump because it's, regular people feel it more, and we don't feel the upswing that corporates do.
Weirdly enough, I think the PSI, the Performance of Services Index, popped out today, and although it's in contraction, and rather steeply so yet again, the one thing that was improving was the sort of negative self-talk factor, I think. Their own sort of negative comments had dropped yet again. So people sort of seem to be saying things are bad, but we believe they're going to get better. Is that what you're saying?
Well, I mean, but we've seen that all year. What we've said is it's currently terrible, but I think it's going to be better in the future. And we've been wrong for about 12 months. And at some point in time, it's like a broken clock. You're going to be right.
We actually bought these mince pies last year. We're just looking forward to enjoying them now.
Yeah, but the thing is, also, it's partly because I think this cycle has been just a lot longer than people expected. So by all rights, if you look at historical patterns, we should have had a recovery by now.
Why did New Zealand's economy spend 2025 on the couch?
Well, we had quite a strong recovery late last year, and pretty much at the end of the summer, it fizzled out. And we had this kind of, the middle of the year was weird, and now we're starting to see those green shoots again. And partly it was because the Reserve Bank in all its glory decided that it had done enough, and it didn't want to do any more. And so the signal was very much that, everything is fine. And people were like, no, it's not. Actually, things are still quite painful. So I hear what you're saying, Paul, but at the same time, you look at what was going with the jobs, nothing. You look at was going on with business insolvencies rising. So people were still getting those signals that were still quite challenging. But really at the household level, what people are experiencing, my cost of my necessities are going up. I have less money available. Yeah. That was the big issue.
You are seeing more money getting spent on groceries. Like as a proportion, more is getting
just starting to turn around now. And I think, but that was it, right? I mean, you look at, we talked about commodity prices, and, the reason your butter prices went up is because global butter prices went up. The reason why we had high food prices is because global commodity prices are up. And it wasn't just that. It was also insurance and rates and electricity. So it was all these kind of things that came on top of each other. But, for me, the optimism for next year is very much around everybody's kind of really fed up with the recession. They really want to do stuff, right? You can't just stop and sit on your hands forever. But you need somebody needs to move first. Who's going to be the first mover? And I think the Christmas season is going to be the critical one for retailers. If the punters turn out and spend a bit of money, I think that's what will kickstart everybody doing a bit more.
Yeah.
You mentioned the Reserve Bank there. So
Yes.
we've had quite an interesting scene just playing out as we're recording this in the last sort of day or so with the new Reserve Bank governor jawboning the market, something I don't remind me when the last time that happened was.
What happens fairly regularly. As soon as they go, markets are completely misreading this, even though their forecasts very clearly show increase in interest rates from the late next year, right? So the reason they're doing it is because they didn't expect mortgage rates to start rising yet. They wanted more time for people to lock in low mortgage rates and start borrowing again so the economic recovery would kick off.
But the average time to get a mortgage application considered now once it's loaded with the bank. Someone I was talking to that is about 7 to 10 days. So good luck getting it done before Christmas. There is a log jam of people rushing to try and get a rate.
But also
sorted.
you can't get pre-approvals and all those kinds of things. So it's actually been, everything's slowed down a lot, right? And it's partly because a lot of banks had reduced their staffing capacity on the mortgage books because the market had been so quiet.
That's all those younger task-related jobs that are going out of the market already. There we go.
But the thing is, I think the Reserve Bank is right to worry because what we don't want is a signal that says everything is hunky-dory. You don't need to change anything. We still need behavior change. And the behavior changes, yes, there is reason to be optimistic, but that will only be true if we're doing stuff. And that means spending money, businesses hiring people, and businesses investing. If those things are not happening, there is no real economic recovery.
And presumably as long as there's some transmission into the lending rates from the OCR that they've set.
And there will, I mean, for anyone rolling off, there still will be. Even with sort of Westpac, I think ANZ joined the bandwagon now.
Kiwibank and ASB sort of quietly quit.
Yeah, but you're still rolling off 6 or 7% down to something a bit lower. Like, yes,
there's still relief.
You might be missing out on maybe $20 a week, which that matters. But you're still sort of pocketing another 400 or so. Like it wouldn't, maybe not 400 a week. Gee, that would be all right.
Where are you living?
Or
he has a really big mortgage.
I have no mortgage. I'm a renter. Back to generation rent, Shamubeel. But it's they are going to have more cash in their pocket, and it's just whether or not that gets mopped up by the supermarkets and the petrol chains and the power bills and the rates bill.
Well, but there's a context here, right? Only about a third of households in New Zealand have a mortgage, 2/3 don't. For older people, this falling interest rates is actually a really big issue. Yeah. I'm hearing about people who are going out looking for more risky types of yield investments, and it gives me the shivers. Remember the whole finance company debacle not that long ago?
There's another great podcast we could promote that a colleague of mine is doing all about the fall of the House of Duval. I'm interested, I suppose, in the actual bubble that really has burst, which is property, and the sort of the massive drop that we've seen that really hasn't recovered. I mean, we're sort of 20 to 30% drops in real terms in the value of some people's assets and so on. Have we finally...
Yeah, I mean...
have we learned our lesson and for how long?
Well, if you look at where those prices have fallen the most, it's places like Wellington and Auckland. Provincial prices haven't fallen nearly as much, but also they rose a lot during the COVID period when there was a big rise. So they've only kind of given back the kind of the very artificial increase we had seen when money was practically free and banks were falling over themselves to lend money. But if you look at prices relative to incomes, they've gone from obscenely expensive to just merely very expensive. So to me, I don't think we've really learned our lesson in the sense that things are still very unaffordable. It's still telling us that, relatively speaking, huge undersupply of housing across New Zealand. Still, at the margin, we're getting better. That's why rents in places like Auckland are falling, because we're building enough homes. People are leaving to Australia, and that kind of those two things are coming together.
Flipping back to the market there a little bit, we were talking about how things need to lift up a little bit, looking locally. Manawa Energy, Marsden Maritime Holdings, Vital, NZ Wind Farms, all did what this year?
They said goodbye.
Are we sort of? It's an emptying out, isn't it?
It's that annoying part of the cycle where it's hard to compete with deep pools of private money that can just come up and just whip things out. So that they were all taken over, and some of them at decent prices. Some of them made sense. That Marsden Maritime one, in terms of trying to unlock Northport, really makes a lot more sense than the convoluted structures that they'd had prior to that.
But if you look at who's turning up, it's a couple of, cross listings basically from the ASX. But, we're not seeing people rushing to, buoy the market and add listings. And
I would wait until, and I know we're not thinking too much about next year, but when you've got SpaceX considering an initial public offering, sort of settling on 1.2 trillion US as your valuation is sort of how Bloomberg was reporting it.
Do you think that's going to unlock a bit of it'll be like a glacial ice melt, whatever it is?
And Anthropic as well, so the creator of the Claude AI chatbot. Those sorts of things that have been held in those private markets, where if you're rich and you've been able to join the club and get hold of those secondary share sales that are too risky for regular people to get exposed to directly, that's the sort of thing that then starts getting people to think more fulsomely about, well, what are those valuations and those things, and whether or not it's for the NZX or the ASX or Wall Street. I mean, Hong Kong's exchange has been going gangbusters this year. Singapore's been sort of quite chunky. India's been going on again.
What are they doing that we're not?
Well, they're at different points in their sort of cycle, and Singapore's also had a lot of support, direct support in trying to list companies here. We've been tinkering around with the rules and moving slowly, as New Zealand loves to do. Like, let's overthink the problem and then have a few consulting rounds and then a couple of working groups.
Change ministers 2 or 3 times.
Oh, yeah, why not? Why not? But there's also local private equity firms haven't been, like, you're looking at their portfolios and some of those are getting long in the tooth.
Yes.
And even if you think about Direct Capital selling down that stake of AS Colour just recently, and they're keeping a 7% stake or so in that, but they'd had that for about 8 or 9 years. That's a long time even for a New Zealand private equity that plays in that middle market.
We saw the same thing, I think, in Aussie with Canva, which had been held quiet for 13 years or something, and it's now looking like potentially an IPO next year, probably.
Yeah, I think we haven't seen the same level of exits from PE funds into this share market either. We've had some bad ones that came through that burnt a few people.
Yep.
And so I think, sometimes the stigma takes a while to kind of work through, but generally speaking, I'm still very optimistic about the New Zealand share market over the longer term, in that if you think about the weight of capital that's coming through KiwiSaver, the private capital that's out there that's going to be crystallized from some of these big companies being sold or IPO'd globally, we are going to see more capital moving around in New Zealand. So I don't think we should be overly negative about the New Zealand market.
No. And it's a good market. The NZX has taken its lumps already in terms of, if you think about when it had the massive cyber attack that knocked it out endlessly through the tail end of 2020. And the recognition back then that it had been underspending on its tech system. Look across at what's happening in Australia. Like the ASX just had an interim report come out, ordered by its regulator, that's now forcing it to hold $150 million Australian more in capital. They have to have a roadmap on how they have to spend more on improving their tech system, because it breaks so regularly. Like, the great nation of Australia that we all love, and it has probably just overstepped in its monopoly position. So we've got a good foundation here, which should be encouraging to investors and potential listing to come in and go, actually, this should be a good aftermarket. It looks after, it creates a good framework for retail investors to have confidence in it. If you've got investors who are confident in it, you should be able to go to them and go, yeah, buy my shares. Let's have a great time. Let's, off into the future.
That feels like a very optimistic place to leave things here. I feel like I need to offer you a pie at this point. It's sour cherry, which I think is a very, very apt way to explain 2025. Shamubeel Eaqub from Simplicity and Paul McBeth from The Bottom Line, thank you very much for joining me on The Shared Lunch. And thank you for joining, for listening, for watching, for whatever you're doing. Take a little break over the summer, but school yourself up. Get ready for 2026. Think about what you learned in 2025. Kumatu. That's us for now.